Hello everyone, this is me Shoaib Shoukath speaking, and yes, we're gonna talk about the topic AS19 leases. Based on the survey that I've conducted, AS19 is being said one of the most difficult accounting standard where they have encountered. Nevertheless, I'm here. By the end of the day, by the end of this video, I'm pretty sure that this is gonna be one of the easiest accounting standard for which you're gonna solve. We'll be having the tips, tricks, magics for to solve. So without further much ado, let's begin. And if you have any updates, if you have any queries, don't hesitate to ask and let's move ahead. So we'll be sticking with clearly from ICAI study material, and based on the study material I have made the summary, and on that summary we will be discussing examples and illustrations all together, all in pack together. So don't forget to share this video for the people in need, and let's move ahead. Shall we? Yes, we shall. So accounting standard 19 leases. So before we begin, let's understand what do you mean by leases. So let's take two persons. I'll be naming the person one as Layman, and let's take another person as Anthony. Okay, Layman and Anthony. So Layman has given, let me draw it properly. Layman has given an asset where Anthony has a right to use for a specific period of time. Specific period. And Anthony in return will pay an amount in periodic. Okay, so Layman has given the asset to Anthony, and Anthony in return will pay the amount in periodic basis. This is the second. For the term, for a particular term. And by the end of the term, Anthony will return this asset to Layman. Return this asset to Layman. This is what known as lease. Understood? In layman terms, if someone asks you what do you mean by leases, this is what the story you need to dictate upon. Okay, you have given the asset on which Anthony has a right to use that however he may like, and Anthony in return will give an amount in a periodic basis, like for a period of term, and by the end of the term Anthony will return this asset to Layman. This is what leases would mean. Okay, and there are two types of leases that we're going to learn in accounting standard 19. Those are finance lease as well as operating lease. The comical part of this is that operating lease is something which is not a finance lease. So just like what we learned in Companies Act, operating lease is something which is not a finance lease. So we will understand what is a finance lease. Finance lease which is not an operating lease. Arre baba, we will understand what is in a proper manner. Okay, so finance lease would be that where the risk and reward is transferred. So if Layman is giving the asset to Anthony for a right to use, he is also transferring the risk and reward, then it is a finance lease. If not, it is an operating lease. Now the next question arises it. What do you mean by, how will you understand, what do you mean by no? How would you understand by the finance lease and operating lease if a question comes or if a transaction happens? There are something that you call as indicators. Okay, if any one of them satisfies, I repeat, if any one of those indicators satisfies, it is a finance lease. Else, it is an operating lease. That's it. You only need to remember that. Out of that 4 to 5 pages, you only need to remember that. Finance lease, operating lease. What is an operating lease? Which is not a finance lease. So you need to understand what is a finance lease, where the risk and reward is being transferred on the inception date. What do you mean by inception date? I'm using a lot of technical terms over here. Please do bear with me. So inception date would be mean that the date at which the lease agreement has been taken place or lease has been transferred. That is mean the inception date. Okay. So the indicator that I said, any one of them should be satisfied. Out of the 5 indicators, any one of them satisfied, it is a finance lease, else it is an operating lease. Based on that, it will be the accounting we will be doing. That is what the applicability of AS 19. Okay, so indicators, any one of them should be satisfied. So first one is lessor transfers the ownership to lessee at the end of the lease term. See, like I said, Layman gives the asset to Anthony. Anthony gives an amount in periodic basis of the term, and Anthony gives this asset in return. And at the inception date, Layman says that at the end of the lease term, when you return, I'm also transferring the ownership to you at the end of the lease term. See, the lease is something that you'll be only given the right to use. You'll be given the risk. You'll be given the reward, but not the ownership. But if there is an indication at the inception date that at the end of the lease term, you'll also be given as an owner, you'll be given an ownership, then it is a finance lease. I hope you get clarity. This is very important for your MCQ perspective. I hope you get a conceptual clarity over here. Okay, so lessor transfers the ownership to the lessee. Who is the lessor? Layman. The one who gives the asset, the one who gets the payment. He is known as the lessor. Okay. He is known as lessor. Now the lessee. Here our case example is Anthony. Lessee is the one who gets the asset and one who makes the payment. Lessee. Okay. So in our case, Layman is lessor, Anthony is lessee. So lessor is someone who gives the asset and receives the payment, and lessee, the lessee means that the one who gets the asset and makes the payment. I hope that's clear. Okay. So the lessor transfers the ownership. Who has the ownership? Layman has the ownership. So at the end of the lease term, if Layman transfers the ownership to Anthony at the end of the lease term and it's given an indication at the inception date, you'll be treating this as a finance lease. Okay, that is what it meant. And the second indicator would be that lessee, that is in our case Anthony, has an option to purchase the asset lower than the fair value of an asset, and it is reasonably certain that he would exercise that option. This is also at an inception date. Layman has given an option to Anthony that he can purchase this asset at the end of the lease term lower than that of a fair value, and Anthony is reasonably certain that he's going to purchase this asset. If that's the case, it is a finance lease. So you need to satisfy both of the condition. He has an option to purchase lower than that of a fair value. Also, it is reasonably certain that Anthony will purchase that asset. Who is the Anthony over here? The lessee. The lessee is reasonably certain that he will be purchasing that asset. That's what it meant. Okay. Then, lease term covers the major part economic life of an asset. This is very common, and this is what the indication that we would take for a finance lease. What do you mean by that is, let's take the useful life of an asset is 10 years. Okay, I'll write an example. Useful life is 10 years. And lease term is 8 years. See, it covers the major part of it. The asset's useful life is 10 years and lease term is 8 years. It covers the major part of it. So, take it as a finance lease. That is what the indicator means that. That means that the risk and reward is almost being transferred that, where Anthony has that use of it. So, the major part of the useful life of that asset is covered on the lease term. So, it will be treated as a finance lease. So, that is what the third point is meant. And fourth point that we talk about, the fourth indicator would be say that at inception date, the present value of minimum lease payment is substantially equal to the fair value of asset. The present value of minimum lease payment. Now the question arises, what does this minimum lease payment, or in the note that I have displayed over here, MLP, what does this MLP means? Minimum lease payment, we will discuss about here. So the present value of the minimum lease payment is substantially equal to the fair value of an asset, then it is a finance lease. Okay, if this indicator comes upon. Then the last but not the least, if lease has a specialized nature where only lessee can use it, no one can use it, only that particular lessee can use it. That is, if someone leases me an asset and only I can use it, no one else can use it, like substitution is not possible over there. If that's the case, it is a finance lease. Okay, I hope that's clear. So if any of these 5 conditions satisfy, it is a finance lease, else it is an operating lease. I hope this is clear for you guys. Okay, so now the next question, based on the indicator number 4, we have said that present value of minimum lease payment. The doubt arisen for you is, what does this minimum lease payment mean? So let's discuss about that, shall we? Yes, we shall. So minimum lease payment is nothing but summation of lease payment and guaranteed residual value payment at the end of the lease term. Let's discuss. Lease payment, all of you know, what we have discussed is here, amount paid in periodic basis. That is what the lease payment over here means. Okay, and guaranteed residual value means none other than there will be an agreement. At the end of the lease term, the Anthony will tell Laleta that I'm guaranteed, I'll be paying you the guaranteed value of the asset worth 1 lakh rupee. If there is such an indication, that should be included in that. That is what it meant. If it goes less than that, Anthony will pay you. That is what the guaranteed lease payment means. That guaranteed residual value means that. Okay, so that does it mean. That what it means with that. Lease payment and guaranteed residual value payment at the end of the lease term. The summation of these two is what the minimum lease payment, and its present value is what discussed over here. So you are learning in financial management paper how to compute the present value. Even if you're very new to that chapter or never touched with that also, nevertheless we'll be discussing further with the samples of the question that we're going about. But I can't go much depth into what does this present value mean. I hope you understand that, because this is a video where we need to have a conceptual clarity. Okay, so let's go further into that. I hope that's clear. So minimum lease payment means that it is a summation of lease payment and guaranteed residual value. You can use the term GRV. Okay, LP and GRV. The summation of lease payment and GRV is what the minimum lease payment means. Okay, so let's discuss further. Now the next part is interest rate implicit in lease. I'm discussing lots of terms over here. Okay, but let's do something. Why don't we discuss an example accordingly, then we will move further. I think that's better. Let me take an example. I think, oh my god, oh my god, oh my god. Okay. Okay. There is an example over here based on the lease term. Let's take it. See, A has taken a car lease for 5 years. After 5 years, the lease term A has an option to purchase this car for 20,000 rupees, whereas the fair value or the market value at the end of the 5th year would be 2 lakh. See, it is less than 2 lakh, which is 20,000 rupees is be given. And considering that it will be reasonably certain that Mr. A would purchase, then this is a finance lease. If the question indicates that what Mr. A won't be purchasing, then it is an operating lease. That's how the indication should be. If question nothing specifies, use your logic. Are Baba, there is an asset worth of 2 lakh and you have an ability to purchase it for 20,000 rupees. Will you purchase it or will you leave it? Of course you would purchase it. You are getting more than the worth. Actually, so because you're paying 20,000 rupees and you're getting a car worth 2 lakh rupees, of course you're gonna purchase it. So it is a reasonably certain that. So sometimes the question doesn't specify. Sometimes the question specifically says that he's not gonna purchase that because of the faulty or something, blah blah blah. So that's the case. So you have to use your logic also in between because you're studying for a CA course. Use your logic bit, Baba. Okay, so I understand that. So I hope that's done. And now let's discuss what does mean by interest rate implicit in lease. This is very much important for your exam point of view, and questions can be tested from here. Okay, what does this interest rate implicit rate mean? It is a discounting rate. Nevertheless, it is a discounting rate where present value of minimum lease payment plus unguaranteed residual value, present value of minimum lease payment plus unguaranteed residual value is equal to fair value of the lease asset. It is as good as what you talk about IRR. You are learning in FM, where it is a rate at which present value of outflow is equal to present value of inflow. You discussed that in IRR. Similarly, interest rate implicit in lease means that present value of minimum lease payment. What does the minimum lease payment means? It is lease payment plus guaranteed residual value. Then present value minimum lease payment plus unguaranteed residual value. Nevertheless, lease payment plus unguaranteed residual value plus guaranteed residual value of its present value is equal to the fair value of the lease asset. On that rate, such rate is known as interest rate implicit rate in lease. Sometimes the question gives you what is this interest rate implicit in lease, is that sometimes the question doesn't give you also. But still you can compute it if you have these figures: lease payment, guaranteed, unguaranteed, and fair value. If you have these figures, you can compute it. How? In IRR, we computed it interpolation method. Interpolation method. Here also we will be computing in. Similarly, we will also compute it over here also. Interpolation method. That's what it meant. We'll do a question and you will understand what do I mean by that. Okay, shall we go ahead with that? Yes, we shall. I think there is an example discussed over here. Let me check it out. Illustration 1 is given the illustration number 2, I guess. Somewhere over here, just a minute, guys. Okay. Yeah, here you go. There is an example one itself. Okay. See, let's talk about annual lease rent 50,000 at the end of the each year. Lease period is given 5 years. Guaranteed residual value is 25,000. Unguaranteed residual value is 15,000. Fair value at the inception, beginning of the lease is also given 2 lakh rupees. This is what the question has been given. Okay. So you are being told to compute the interest rate implicit on the lease. That is what we told. So let's do that also. Let me write it here over here. Fair value. What does it? What's the fair value? 2 lakh rupees. Okay. Then lease payment 50,000 per year. Lease term 5 years. Okay. Then guaranteed residual value. Guaranteed residual value is nothing but 25,000 rupees. And unguaranteed residual value UGRV is nothing but 15,000 rupees. That is also given. Okay, this is what it is being given. Now, let's discuss how to compute the implicit rate. So here what you need to do is implicit rate, you know the definition, is nothing but present value of lease payment plus guaranteed residual value, which is nothing but MLP, plus unguaranteed residual value is equal to fair value of leased asset. This is what it means. You know the fair value of leased asset, which is nothing but 2 lakh rupees. So you need to find a value on which the present value should be equal to 2 lakh. That's what the question. So you need to do what? Interpolation method. I know students tend to find difficult with interpolation method. I will be solving with X method. Okay. I'll be calling that as ex-girlfriend method. No problem. So let's move ahead. The lease term is 5 years. So let's take it in the term. You have to do a trial and error over here. So at 10 percentage, at 11 percentage, at 12 percentage, you have to check it accordingly. In such a way that what do I mean that the rate what you take should be here. If you compute it one rate, the value should be here, and if you compute it another rate, the value should be here. On that basis, let me tell you an example. At 10 percentage, if you compute the present value, let's take it here. I'm not doing much depth into it. 3, 4, 5. Then that will be what? 50,000, 50,000, 50,000, 50,000, 50,000 plus 25,000 plus 15,000. You understand what you mean by that? Residual value means what? At the end of the lease term, the value of an asset. That is the total residual value. Out of that, the guarantee is given by the lessee. The rest part is unguaranteed value. That's why I have added the total over here. Okay. And at 10 percentage, you have to compute that. I'm not doing much depth into it. I'll be taking based on the question what I've given. So 10 percentage they have taken. They have computed the present value. They've taken the discounting factor 1 divided by 1.1 and they have computed over here. Normally the question gives you the rate, but nevertheless, even if the question doesn't give, you can compute it as it is. Okay, you have to take it up to the 4 decimal point. Sometimes the question takes it 3, sometimes takes it 5, but take a standard for your exam, take it up to 4 decimal point. Okay, so in this case, at 10%, the value comes about 2,14,340. 2,14,340. So at 10 percentage, it comes 2,14,340. Okay. Then the next rate they have taken is 14 percentage. Okay. Similarly, when you do it at 14 percentage, you have to do that year 1, 2, 3, 4, 5, and the value you're going to get is 1,92,360. 1,92,360. So 192,360. Okay, so it comes in between 2 lakh rupees. 1,92,360, 2,14,340. 14 percentage, 10 percentage. So many of you find that equation very difficult. I'll be telling you in an ex-girlfriend method. Don't write in exam ex-girlfriend. I'm taking like such a way that the rate X is nothing but implicit rate. Okay? Implicit rate. You take it like that. So 14 percentage, or in other words, I will write 0.14 minus X divided by 0.14 minus 0.1. Okay. This is 14% is 0.14, 10% is 0.1. Okay, so 0.14 minus x divided by 0.14 minus 0.1. That's what I did. So 0.14, the value that I got is 1,92,360. 1,92,360. And x, what do you want? The value equivalent to 2 lakh rupee, right? Take here 2 lakh rupees. Okay. Just a minute. 2 lakh rupee I have taken. That x equivalent. What do you want? The rate at which the present value should be equal to 2 lakh rupee. That is why I have taken over here. Okay. So at 14%, what is it? 1,92,360 only. Minus 2,14,340. 2,14,340. So you will be getting a value 0.14 minus x divided by 0.04 equal to, let me take the calculator, 1,92,360 minus 2 lakh rupees, that comes to negative 7,640 divided by 1,92,360 minus 214,340, that comes to negative 21,980, that comes like that. Okay, so x equal to 0.14 minus 7,640 divided by 21,980 into 0.04. Okay, so 7,640 divided by 21,980 into 0.04, that comes to 12.61%. This is your implicit rate. That's it. I hope you get a clarity. When you look at the answer key, yes sir, 12.6. I did one more decimal extra. That's it. So I hope you got a clarity based on how to compute with the implicit rate. I hope the ex-girlfriend method found easy for you. Don't write it exam. I repeat it again, and don't complete it to me also. I'm just giving you a reference on how to remember it. I use this method for my CA final exams, like CA final examination, and for my AFM paper, and also for during my intermediate for my FM paper also. This X method. I hope this helps you too. Okay, so adivali. Now I hope you understood what do you mean by implicit rate. Now let's discuss the next part. How would lessee record the value of asset if it is a finance lease? Let's keep an aside about operating lease. In finance lease, in case of lessee, who is lessee? The one who gets the asset and one who makes the payment. That's the lessee. So one who gets the asset, lessee, if it's a finance lease, he needs to record the asset. That's what the finance lease means. So in that case, how would he record and at what value should he record? So the journal entry is nothing but this. ROU asset account debted to lease liability. That's the entry. Now the next question is, what would be the value over here? The value is lower of the following. Whichever is lower. It is the fair value of the leased asset. Fair value of the leased asset, or let me write it over here, or present value of minimum lease payment at the viewpoint of lessee. I have written at the viewpoint of lessee means that the rate will be taken over here won't be implicit rate on lease, because interest rate implicit on lease would be on for the lessee basis, lesser basis. For lessor, this rate is needed. For lessee, this is not the rate he'll be taking. He'll be taking the rate which we know as incremental borrowing rate. That's the rate he will be going with it. That is why I have written viewpoint of lessee. That will be given in the question. You don't have to go deep into it. For lesser perspective, you need to compute that rate based on the interpolation method, provided you need to have the figures which are minimum lease payment, UGRV, GRV, and fair value. If you have these four figures, you can compute what? The implicit rate using interpolation method. That is what it means. If any of them is missing, you will be taking the rate at which the lessee is also taking, the viewpoint of lessee, which is nothing but the rate is incremental borrowing rate. That will be given in the question. You don't have to go deep into that. Okay. So in summary, lessor records the lease receivable. See, lessor's perspective is what? He gave the asset. He's going to get the payment. So lease receivable, he'll be getting the payment. So that lessor will be recording the lease receivable, the present value, at the implicit rate. Okay. So lessee records the lease liability. Why did I say lease liability? Because in lessee's perspective, I got the asset. I have to make the payment. That's a liability. So if I'm making the payment, I'll be recording at the incremental borrowing rate. That's it. And if the implicit rate cannot be found, out of this 4, you'll be getting the what? Minimum lease payment. That is lease payment amount and GRV. How? In the contract it is mentioned. Unguaranteed residual value is something that will be missing. Why? Unguaranteed residual value is based on the estimation done by the lessor that at the end of the lease term, the residual value will be so and so. Out of that, the guarantee will be given by the lessee. The rest part, it will be unguaranteed. So if you can't compute the total, how can you find the unguaranteed? So there will be a missing figure. If the case that is. So if that is, if you can't find the residual value, fair value can be computed based on the market rate. Okay. So if implicit rate cannot be found or cannot be computed, you will be taking the incremental borrowing rate like that, how we have discussed right now. So that's it. So without further much ado, let's go and dive into the question. Let's go ahead with the illustration as such. You need to solve the examples over here to get a better understanding because the questions over here are very less. So illustration number 1. Let's go ahead. Esquire Private Limited has taken the machinery on finance lease for SK Limited. The information is as under. Lease term is 4 years. Fair value of the inception of lease is 20 lakhs. Lease rent is 6,25,000 per annum at the end of the year. Guaranteed residual value is 1,25,000. Expected residual value is 3,75,000. So he expected 3,75,000. Out of that, 1,25,000 is guaranteed by the lessee that he will make the payment at the end of the lease term. So the rest value, that would be 3,75,000 minus 1,25,000. That comes to 2,50,000 is your UGRV. That is what it means. So you got your GRV, you got your UGRV, and you got your lease payment. So you can compute the implicit rate, and you also have given the fair value. You can compute the implicit rate. But the question has given 15%. If the question given 15%, don't go and compute on your own. Humble request is that. Don't go and check in the question that is that implicit rate is equal to present value of minimum lease payment plus GRV is equal to the fair value. Don't go and compute that. Not only that, you will waste your time in the exam. ICAI won't give you the mark. See, ICAI has given the specifically that what is the rate. You have to use that. And plus, they have also given the discounting factor also. Discounting rate for that 15%. 0.8696, 0.7561, 0.6575, 0.5718. Don't go and compute for discounting factor 15% for 8 figures, 9 figures, 10 figures. Don't do that. Because their answer key will be based on these rates. So make sure you take these decimal points and accordingly compute it. This is very crucial and very important because students tend to lose mark. Not in CA Inter, but in CA final. In CA final, there was an issue that out of this 4, the question has specifically given 4 decimal point. A student, what he did that in order to get the perfect accuracy, he did it out of 7 decimal point or 6 decimal, something like that. He did it, and he computed. Domino effect it has come because the answer is nowhere matching with the answer what I have given in the institute. Domino effect it came. He lost the mark. He didn't get a mark. Like he hardly got out of that 10 mark. Like 2 mark or 3 mark he got. He lost it. He knew the answer, he did it. But he did an over smart approach that what? Instead of 4, he made it more accurate. Don't do that. Go with what the question specifies. Okay, I hope that's clear with you. Now, let's move ahead. So, the discounting rate is again calculate the value of lease liability. How do you calculate the value of lease liability? Lease liability is nothing but what we have discussed, lower of fair value or present value of minimum lease payment. Why did I write unguaranteed residual value? Because it is on the perspective of Esquire Private Limited, the one who taken the machinery and one who making the payment. See, if I am making the payment, why should I bother about the unguaranteed part? I should only bother about what could be my possible outflow. What are my outflows? Lease payments and guaranteed residual value. These are my possible outflow. That is only be required. So for Esquire Private Limited, who taken the machinery and who requires to make a payment, he only needs to make a present value minimum lease payment. Whichever is lower, that needs to be your lease liability. So present value of minimum lease payment. Minimum lease payment is what? Lease rent plus guaranteed residual value at the end of the lease term. That is 4th year, you need to pay this also. 6,25,000 plus 1,25,000. So let's take it out. 6,25,000, 6,25,000, 6,25,000, and you can write it separately or you can write it together also. 6,25,000 plus 1,25,000. And you have taken the discount effect and you have found the present value 18,55,850. So present value minimum lease payment is 18,55,850 and the fair value is 20 lakhs. Whichever is lower, that needs to be the lease liability. 18,55,850. This needs to be taken. I hope it's clear. That's it. ROU asset account debtor to lease liability 18,55,850. That would be the value. Therefore, the asset and corresponding lease liability should be recognized at 18,55,850 as per AS9D. I hope that's clear. Now let's move ahead with the next illustration. Now let's go ahead and discuss with the next topic known as unearned finance income, which is nothing but on the perspective of lessor. Lessor. On the perspective of lessor. Why I have used the word income? Income is for what? For someone who's receiving the money. Who is receiving the money over here? The one who given the asset. That is the lessor. In our case, Layman. Layman has given the asset and he is receiving the money from Anthony Peribauer. So from Anthony he is receiving the amount, and in that case, what would be the here? In lessor's perspective, what will be, how will be accounting here? It will be the present value of minimum lease payment plus UGRV. That will be the case. Right now, for the sake of our example, from based on illustration 1, I'll be taking an assumption that 18,55,850 is the present value of minimum lease payment plus UGRV. That is not the case. You need to compute it separately. But right now, for the sake of our example, I'm taking here as 18,55,850. And I have drawn the lease receivable table. Lease receivable table is nothing but, you know, the implicit rate. You know the implicit rate. Okay, it's given. So it's nothing but the rate will be computed on the opening. That's how the lease table is prepared. You guys know about it. So 18,55,850 plus 15% minus lease payment will give you the closing. So when you compute over here, you will get the total value of the finance income. The total value of such finance income is known as unearned finance income. Okay, that's what it means. Why did I say unearned finance income? Because in the perspective of lessee, is he actually earning this finance income? He is earning the lease payment, right? He is earning this 26,25,000, the total amount. That's what he is earning, not the finance income. It is just for the sake of an accounting. That is why it has been said. So there is a shortcut to solve that. Even the ICAI is also using this shortcut. It will save your time. Gross investment, that is minimum lease payment plus UGRV. In our case, it is 26,25,000. That will be the value. Minus present value of minimum lease payment and plus UGRV. That is 18 lakh 55,850. When you do the difference, you will get almost the same answer. Why did I say almost same answer? Because you have taken the implicit rate in rounding figure. That is one possibility. You have taken the discounting factor up to 4 decimal places. That is also rounding off issue. So if such a, and you also completed the table in the rounding off figure also. So if such case occur, the value can be differed in a very minute amount. In this case, 100 rupee or 200 rupee will be differing. But nevertheless, unearned finance income is nothing but minimum lease payment and unguaranteed residual value. You got the total value, which is nothing but gross investment minus its present value. Its present value. The difference of that, it is the unearned finance income. I hope that's clear. When the illustration is also solved in such a way. So you know what is a gross investment means? It is lease payment plus GRV plus UGRV. That's it. So let's discuss about here. So you have the question. Okay. Guaranteed residual value 160 and expected residual value 300. You have to split it out. So 160 and 140 is given. So this is your UGRV. This is your GRV. This is your lease payment per annum. You need to take it for 5 years into 5. So 8 into 5, you have to take 40 lakh plus 1,60,000 plus 1,40,000. That will be your gross investment. And based on that, you need to compute the present value also with that amortization table. You will get the value over here 27 lakh. 28 lakh 3920. Sorry, 28 lakh 3920 you will get in here. Okay, and you got the gross investment minus the present value of minimum lease payment plus UGRV. That's the difference of it will be unearned finance income. I hope that's clear. Do the illustration, you will get the clarity. I hope you're getting a conceptual clarity based on this video. I can do everything over here in the short span of time. So that's clear. Now let's discuss about the next part of our topic, operating lease. Now we have discussed till now regarding the finance lease. Now in operating lease, it's quite simple. Accounting in the books of lessee, there are 2 and 2 entries only for this case. That will be on yearly basis. That would be, normally it is rent account debted to bank. You have to book it as an expense. But you have to add an extra part that will be prepaid rent account debted. What do I mean by that? In question or like in your material, this part is written like lease equalization. That's what they have written. It's none other than prepaid rent. That's what it meant. How does this prepaid rent comes? Because you are paying rent based on the yearly agreement, right? On yearly you have to pay such and such amount. That's what it agreed upon. So rent account comes that only if you get the benefit, right? You have to record the rent. You have to record an expense only if you get the benefit, right? Who is getting the benefit? The one who makes the payment. Who is making the payment over here? Lessee. Lessee makes the payment. So if lessee makes the payment, he has to record the expense only the basis he gets the benefit. Normally on lease contract, he is getting the benefit on the yearly terms and what the basis that has been agreed upon. So in yearly he has agreed an amount, but he only got a benefit on basis of that output. Okay, so this comes only in the basis of manufacturing sector. In manufacturing sector, the benefit will be accounted on the basis of production. On the basis of production, it has been accounted. There is an example in your textbook. We'll be discussing on the basis of that. Okay, so let's go ahead. Let me clear the screen. Okay, so let's discuss here. Suppose output from a machinery is taken on a 3-year operating lease and are estimated as 10,000 in year 1, 20,000 in year 2, 50,000 in year 3, and agreed annual lease payment is 25,000, 45,000, 50,000 for yearly basis. So at the end of year 1 you have to pay 25,000, at the end of year 2 you have to pay 45,000, at the end of year 3 you have to pay 50,000. That's what has been agreed upon. So you are sure at the end of the year term you have to pay 25,000 rupees, and the total lease amount is that 1,20,000 rupees. 25 plus 45 plus 50, 1,20,000 rupees. Okay, and since this is a manufacturing sector in this example, the only benefit you're getting that on year-end production, at the end of the year one, the production you're getting is 10,000 units out of 50 plus 20 plus 10, 80,000 units. So 10,000 divided by 80,000 into the total lease payment. When you check it out, the only benefit you're getting is 10,000 divided by 80,000 into 1,20,000 is 15,000 rupees is what you're getting the benefit. So you have to record an expense only if you get the benefit. The rest extra you have to show it as a prepaid rent, right? So in this case, you're paying 25,000 rupees, but you're only getting a 15,000 rupees as a benefit. So rent account debted will be shown as 15,000. You will pay 25,000 rupees, either bank or lessor. It could be either case. And the rest 10,000 will be the prepaid rent. And you have to use the word lease equalization account. Are you clear with this? Perfect. So that's what it's been talking about. Then P&L account data to rent. And in yearly basis, you have to do that. And this lease equalization account will be squared off at the end of the lease term. Whatever the balance figure that, it will be transferred to profit and loss account. That's what it meant. Okay. So this is what operating lease is been talking about. Okay, now let's discuss about the next part of our topic, which is our last and ending, where we'll be talking about sale and leaseback. What do I mean by sale and leaseback? Before I begin, this is the hot topic where it is important as well as students find this topic difficult too. The reason why they find difficult with AS19 is regarding this part predominantly. Okay, so let's make that simple, shall we? Stick with me and we're gonna make this up very much with an illustration in a proper ease. So sale and leaseback. Before I begin, let's understand with the story with the same characters, Layman and Anthony. Okay, the first floor, Layman has sold this asset to Anthony and Anthony has given you the cash. Take me as a Layman. So I have given this asset to Anthony, sold this asset, not just for a lease. Lease is something that you are giving a right, not only right. I'm giving the ownership at the instant itself. I'm transferring my risk. I'm transferring my reward. I'm transferring my ownership. I'm also transferring the right also. So I'm selling this asset to Anthony, and Anthony is giving me the cash at the same day itself. Now, whose ownership this belongs with? Anthony, right? So Anthony has leased back this asset to Layman, and Layman is making the lease payment. That's the case being discussed over here. Flow number 2. So flow number 1, Layman sold this asset and received the cash, and Layman got this asset from Anthony, where Anthony will be as a lessor. Anthony is leasing this asset to Layman, and Layman is making the payment, lease payment. When you combine these two transactions, it is as good as that Layman has received the cash from Anthony, and Layman is making a periodic payment. If you combine this transaction, where asset is not moving, it is as good as this is a loan transaction. Made it such a complex way, but this is as similar to a loan transaction, and AS19 is giving such an accounting treatment on how to do this based on the standard. If you look at the textbook, if you look at the answers, I understand it tends to be difficult, but I'm gonna give you a trick to solve this. So the first step you need to do that when Anthony leases this asset to Layman, you need to understand what type of lease is this, operating lease or finance lease. What is an operating lease? Which is not a finance lease. What is a finance lease? Which is not an operating lease. Arey Baba, finance lease is something but where the risk and reward is transferred. And how would you check that? Any one of those 5 indicators needs to be satisfied. That is what the finance lease has been talking about. So, if it is a finance lease, this is very simple. Very simple. Finance lease would be, you have to check the carrying value in the books of Layman. In the books of liability, what is the carrying value of that asset and what is the sale price? That is, in the flow number 1, when Laleton sold this asset and Antony has given the cash to Laleton, that sale price needs to be determined. That difference needs to be amortized or deferred over the lease term. That is what it meant. Okay, if it is a finance lease. Perfect. Now, if it is an operating lease, this is very important. This can be tested in your exam if they ask AS90. And this is where the difficulty comes. But it's not so difficult if you go with the flow. Okay, so what you need to do, you're also learning in the taxation where you're learning income from house property. Similar process I'm applying over here, so you can connect and learn also. Carrying value in the books of liability. Okay, you got the value. Carrying value in the books of liability. You know the value. Then fair value at the time of sale. That will also be given in the question. At the time of sale, what will be the fair value of that asset? Whichever is lower, that is your revised carrying value. Okay, that will be known as revised carrying value. Revised carrying value is the lower of carrying value in the books of liability and the fair value at the time of sale. And you need to understand that if carrying value is more than fair value, see, in the books, it is 1 lakh rupee and fair value of that asset is like 50,000 rupees. In AS1, you are learning something called as prudence concept. In prudence concept, it has been told that you have to value lower of that. So, the difference needs to be charged to profit and loss account. That is what we've been told about. Okay, AS1, you are learning that. So, I'm not going much depth into it. That needs to be charged immediately to the profit and loss account. That if the lower value comes as the fair value. Okay, if it is a carrying value, do nothing. Just show as it is. Carrying value is the revised carrying value. That's it. If the revised carrying value is the fair value, I said it's a lower. If it's a fair value, then the difference needs to be charged to P&L immediately. That is what it's been said. Okay, AS1, not going much depth into that. Okay, now you got the revised carrying value. Now you got the revised carrying value and the sale price is also been determined. You can get in the question. Flow number 1. Okay, you will get the difference amount. Now the treatment starts. You got a difference amount. Let's take the difference amount you got it as 10 rupee or 15 rupee, whatever the case might be. The first thing you need to check is that if the sale price is less than or equal to fair value, check that. If it is a sale price is coming 50 and if it is a fair value is like 60, if this such case satisfy, what you need to do? Immediately charge such difference to P&L account. That's what it said. Immediately charge. But if sale price is more than fair value, if it is sale price is more than fair value, then the trick comes. Difference is that the difference of sale price and fair value. Let's take sale price is 100, fair value is 80. You got a difference of 20 rupees. Okay, so sale price minus fair value 20 rupees will be amortized, and let's take a difference what you got over here. Instead of 10, let's make it 30. Okay, 30 the difference amount comes over here is 30. So the balance 10 will be immediately charged to P&L. Now the next question arises that what if the difference amount comes as 15? So what you need to do is that even though you got here 15 and difference, 15 not 20, you got here as 20 in our case and difference is 15. Whichever is lower will be amortized. That is 15 rupees will be amortized. So in our case there will be no balance. Take an account of this. Okay, so I hope this has been clear. If you go with this flow, first check the carrying value in the books of liability, then fair value at the time of sale. Whichever is lower, that will be the revised carrying value. Compare that with the sale value. You will get the difference. If the sale price is less than or equal to fair value, immediately charge that to P&L. If the sale price is greater than fair value, that difference needs to be divided into both. The difference between the sale price and fair value needs to be checked. Compare, then check the difference. Whichever is lower needs to be amortized. If there are any balancing figure, that needs to be immediately charged to P&L account. Okay, I hope this is clear. If you go with this flow, you will never go wrong. Don't trust me? Let's check it out. Okay, let's go with the answer key. We have an illustration. We will solve that illustration and I'm going to prove it to you based on what we have learned. Yet we will never go wrong. If as such, sale and leaseback question comes upon, that will be the easiest for you. Okay, A Limited sold machinery having the WDV of 40 lakh to B Limited for 50 lakh, and the same machinery was leased back by the B Limited to A Limited. The lease back is operating lease. So now let's check it out. You got the carrying value, you got the sale price, and the question has given operating lease. If it is given finance lease, it is very simple. If instead of operating lease, if it's given finance lease, don't look into it. Whatever the difference amount is, like carrying value, sale price, whatever you get the difference amount, amortize or defer over the term of the period of the lease term. That's what it said. But since the question specifically said it's an operating lease, you need to respect that also. So sale price given 50 lakh, which is equal to fair value. Now let's do with an illustration. Shall we? Yes, we shall. Let me rub this out and accordingly we'll solve it out. So case number 1. Okay. Case number 1. I'll write it over here. What is carrying value? Carrying value in our question is 40 lakhs. 40 lakhs. Fair value in our question, it said that sale value is equal to fair value, that is 50 lakhs. Whichever is lower, what is that? Revised carrying value 40. See, if CV and CV is same, the value is same, then nothing is need to be done. If it is different, you need to charge that difference immediately to the profit and loss account. Don't forget that. Okay, now the revised carrying value is given. Now check the sale price. What does the sale price given? 50 lakhs. You got the difference, 10 lakhs. Okay, now you need to check that. Check the condition. Sale price is less than or equal to fair value. What is the sale price? 50. What is the fair value? 50. It is equal to. So the condition satisfied. So the difference immediately charge to P&L. What did it say? Let's check the first answer. A Limited should immediately recognize that 10 lakh rupee in the books of accounts. That's what it said, charge in the P&L account. Okay, immediately charge to profit and loss account, that difference. Now, let's move ahead with the next part. Carrying value, the question, let's check it out, the question. Fair value is 60 lakhs. Carrying value is 40 lakhs. Fair value is 60 lakhs. Whichever is lower, 40. CV, same to same. Nothing much difference. No need to check about it. Then sale price. What does the sale price given in the question? 50 lakhs. And the difference 10. What does it go with? Now you need to check if the sale price is less than or equal to fair value. Sale price comes as 50. Fair value comes as 60. It is less than or equal to that. So the condition is satisfied. Immediately charge to profit and loss. That's what it said. Now let's check the answer also. What does it say? 10 lakhs should be immediately recognized by A Limited. That has been said. That is also done. Now let's move ahead with the third part. A, B. I said A, then B, then comes the C. Okay. What does the C say? Fair value is 45 and the sale price is 38 lakhs. Okay. Fair value is 45. Fair value is 45. 40. Whichever is lower, 40. Same to same. In CV, same. So that's done. Now next, selling price. What is the selling price given? 38 lakhs. 2. Let's check. Sale price is less than or equal to fair value. Let's go ahead. Sale price comes as 38. Fair value comes as 45. Yes, condition satisfied. Immediately charged to P&L. It comes as loss. Immediately charged to P&L. Here it came profit, here it came profit, here it comes loss. So recognize that. Done. And yes, let's check that answer also. Immediately recognized by A Limited. Okay. B. Fair value is 40 lakhs. Sale price is 50 lakhs. Let's go ahead. Fair value is 40. Sale price is, what did it say? 50. That's what it said. Okay. Carrying value also given 40. Fair value is 40. Whichever is lower 40 and less 50. That difference comes as 10. Okay. Now let's check it out. Sale price is less than or equal to fair value. We need to check that. What does the sale price comes in this case? Sale price in our case, sale price is 50, fair value is 40. No, the condition does not satisfy. Now you need to go with that Dabba table. Difference 10. Okay, 10. You need to check that. Sale price minus fair value. How much that comes to? 50 minus 40, 10. And difference also 10. Whichever is lower, 10. This needs to be amortized over P&L. Over P&L. Balance is 0, immediately charged to P&L. Nothing is there. So forget about it. I hope that's clear. Okay. So when you check with that, yeah, the profit of 10 lakh needs to be deferred or amortized over the lease term. That's what it said. Okay, now let's move ahead with the next part. Shall we? Yes, we shall. Fair value is 46 and sale price is 50. Fair value is 46 and sale price is 50. That's what it given in the question, right? Yeah, E. Carrying value is 40. Whichever is lower, 40. Same to same. Nothing much of a difference. The difference comes as 10. The first condition needs to be checked. Sale price is less than or equal to fair value. So sale price comes as 50. Fair value comes as 46. Fair value comes as 46. Obviously, the first condition does not satisfy. So it is coming as the second condition. And you need to go with the flow. Let me rub this. Okay, so let's go ahead and check it out. So sale price in our question. Why do I need to check here? We'll go here and check. Okay, sale price is coming what? 50. Sale price minus fair value. 50 minus 46, that comes to 4, and difference is coming as 10. So whichever is lower, that comes to 4. This needs to be amortized over lease term, and the balance 6 needs to be immediately charged to P&L account. Let's check the answer too. Okay, shall we? Yes, we shall. Okay, E. 46 lakhs and sale is 50. The profit of 6 lakh needs to be immediately recognized and the balance of 4 needs to be amortized. See, they use the word balance over here. It's just a theoretical words. Doesn't matter. If you go with the flow, what I have discussed, you can never go wrong. So go accordingly and try to solve it. Let's go with the point number F also, and then you will understand what do I mean by that too. Okay, why do we need to miss that? So go with point number F. What does point number F means? Okay, carrying value. What does the question says? Oh, question also needs to be checked. Fair value 35, sale price is 39. So fair value is given 35, sale price is 39. Okay, 39. Carrying value is 40. Whichever is lower, 35. See, CV, not same. Carrying value and revised carrying value, it's not same. There is a difference of 5 rupees, 5 lakhs. This needs to be immediately charged to P&L. Prudence concept, what you have discussed, AS1. Okay, immediately charged to P&L. Don't forget that. Okay, now 35 minus 39, that comes to 4. This needs to be checked upon. Sale price minus fair value. Okay, sale price is what? 39. Sale price is 39. Fair value is 35. It is greater than. So the first case is not satisfying. So you need to go with the another flow. That's 4. You need to split and check. So sale price minus fair value, that is 39 minus 35, that comes to 4. Difference 4, whichever is lower, 4. This needs to be amortized. Balance is 0. So if you check it, the answer, let's check it out. The loss of 5 lakh needs to be immediately recognized by A Limited. Prudence concept, what we have discussed. And the profit of 4 lakh needs to be amortized and deferred over the lease term. That is also been discussed. See, if you go with the flow, you will get the answer. What flow? This one. Take a screenshot of it and you will understand what we mean by sale and lease back. I hope you got a conceptual clarity and you can never go wrong with this. Okay. So with this, we have completed AS9 and we got a conceptual clarity. We could have gone much depth into it, but let me tell you something. You are learning for CA course. In CA course, you learn what require for your exam right now. Whatever you require to learn, go depth on that. Don't go much deeper into it because you're not going for doctorate, CA exam. I'm repeating it again. And you need to make it understanding, and you need to complete the whole syllabus also, not only for this paper but also for all other papers also. So have a conceptual understanding and accordingly try to solve it. Okay, so I hope this was very informative and as well as a quite fun with learning also. If you need more content with that, please don't hesitate to contact me, and also please do mention in the comment box. Try to make a use of it also, like what all you need to require in the future sessions. So this was conducted based on the survey and based on the request that I got from many of my friends and students, and accordingly I have given you, and I hope AS19 is in your hand. So almost 1 hour is done, and with all the illustrations, examples, as well as the conceptual clarity. Now only thing is left with your test your knowledge. That is as similar to what we have discussed in illustrations. Okay, if you need test your knowledge also, I'm happy to help, but I need your support from your guys. So if you need any more videos, I'll be at your expertise, and they'll be discussing accordingly throughout the sessions. So AS19 was difficult for you. Now I hope it's easy. If you find any more other chapters difficult, mention in the comment box. Please do like, share, subscribe, and accordingly they'll move it ahead, and let's make this attempt as ours. Take care, have a great day ahead, and all the best for your exams. I hope the studies are going in full swing. Take care and have a great day ahead.